Welcome to Talk Tickers. So our mission here is always the same, right? We cut through the Wall Street jargon and deliver a data-forward, actionable breakdown of corporate earnings calls for retail investors.
Right, and usually we promise to get you those key takeaways in under 5 minutes.
Exactly. But today we are doing a full deep dive because this specific quarter just demands it. We are looking at Aflac, ticker symbol AFL. And, you look at a stock chart for a company that has been paying increasing dividends for over 40 years, and you might assume, well, you're about to watch paint dry.
Yeah, you'd think it's just a sleepy dividend stock.
Right. But beneath the hood in this Q2 2026 earnings report, Aflac just executed a $4.8 billion currency maneuver. And it completely defied the weak Japanese yen.
It really did. It's honestly a remarkable piece of financial engineering.
Yeah, they basically harvested foreign exchange gains to organically upgrade their entire global bond portfolio. So they captured higher yields without taking a capital hit.
Which is incredibly hard to do.
It is. So let's look at exactly how they pulled that off. Because we are not looking at a sleepy dividend payer today. We are looking at a highly tuned, aggressively managed financial fortress.
Absolutely. And I mean, to understand how they execute at that level, you have to fundamentally shift your perception of what Aflac actually is.
Right, because everyone just thinks of the duck.
Exactly. Most retail investors see the duck on the commercial and think, oh, it's an American supplemental insurance provider. But in reality, Aflac is a massive, systemically important Japanese financial institution.
That just happens to have a U.S. business on the side.
Right. They run a highly profitable, mature U.S. business on the side. But when you view the company through the lens of Japanese macroeconomics, everything in this quarter's earnings call takes on a much sharper meaning.
So true. So let's get right into the actual data then, the headline numbers.
Let's do it.
Okay, so adjusted earnings per diluted share came in at $1.75. But if we strip out the foreign currency fluctuations, and trust me, we have a lot to say about the yen today, that number actually sits at $1.80.
Which means it's up 1.1% year over year.
Right. And Aflac U.S. sales grew by 2.6%. But over in Japan, sales actually declined 5.6% for the quarter, landing at 11 billion yen.
Yeah, but you have to look at the first half of the year cumulatively there.
Right. Japan sales are still up 7% for the first half. But to me, the real story here is the profitability.
Oh, absolutely. The margins.
Yeah.
Yeah.
Japan's pre-tax margin absolutely crushed it at 34.3%. That is up 230 basis points.
Which is massive in insurance.
It's huge. Meanwhile, the U.S. segment stayed relatively solid, but it did dip 160 basis points down to 20.9%.
And honestly, the divergence in those margins is the central narrative of the entire quarter.
You think so?
I do. Because look, you have this slight EPS growth of 1.1%.
Yeah, which might look stagnant to a growth investor who's just scanning the headlines.
Exactly. But you have to contextualize what is happening underneath that flat top line figure. That slight growth masks a quarter that was profoundly profitable on an operating basis.
But it was heavily masked by the weak yen when translated back into U.S. dollars for GAAP reporting.
Right. That translation effect hides the true operational strength.
I always view Aflac as, like a twin engine plane. You have the U.S. engine and the Japan engine, and they are running at very different RPMs.
I like that analogy.
Yeah, and they balance the aircraft perfectly. So over in Japan, the sales growth engine sputtered a tiny bit this specific quarter, down that 5.6%, but the efficiency of the engine is generating massive power.
Because pushing a 34.3% margin on a multi-billion-dollar revenue base is just a colossal amount of money dropping straight to the bottom line.
Exactly. And then you have the U.S. engine, which is chugging along with steady premium growth, up 2.6%, but it's burning a little more fuel to get there.
Hence the margin dropping a bit.
Right. And in the insurance business, we know that margin expansion often drives the ultimate bottom line far more aggressively than top-line sales growth.
100%. Expanding margins by 230 basis points means they are pricing their risk phenomenally well.
And their claims are coming in lower than their actuarial models predicted.
Yep. And they are ruthlessly managing internal expenses.
So let's talk about those expenses, because the internal expense management is perhaps, the most impressive part of that Japan margin story.
It really is, especially when you consider that Japan is currently facing about 3% inflation.
Right. And we know inflation is traditionally a margin killer for insurers.
Oh, it's brutal. Because your fixed operational costs rise, but your revenue, especially on older flat rate insurance policies, stays completely static.
You can't just hike the premium on a policy you sold 10 years ago.
Exactly. Yet, despite that 3% inflation, Aflac reported that their expense ratio in Japan actually dropped.
Down 40 basis points, right?
Yeah, down to 20.2%.
Okay, I really want to push on that for a second, because a shrinking expense ratio in an inflationary environment where top-line sales also contracted by 5.6% for the quarter, that implies they're cutting to the bone.
It sounds like it, yeah.
So my question is, are they underinvesting in the Japanese business just to prop up the quarter's margins? I mean, are they starving the engine?
It's a fair question, but the evidence points more toward structural modernization rather than just, defensive cost cutting.
Okay, how so?
Well, managing fixed costs when the revenue base is slightly shrinking in yen terms is brutally difficult. But the 3% inflation in Japan isn't primarily wage inflation.
Right, it's imported inflation.
Exactly. It's driven by the weak yen making energy and raw materials much more expensive. So Aflac is countering this by aggressively digitizing their claims processing.
So automation.
Yes. They're streamlining agency interactions, pushing everything digital. And they are guiding for a long-term expense ratio in the 20% to 23% range.
And they just hit 20.2%.
Right. By operating at 20.2, they are currently sitting at the absolute most efficient frontier of their own target.
Wow. So it suggests their investments in automation from, 3 or 4 years ago are finally yielding sustainable leverage.
That's exactly what's happening. The operational leverage is clearly there.
Okay, that makes sense. But let's look closer at that 5.6% sales decline in Japan.
Yeah, let's unpack that.
Because on the surface, shrinking sales in your primary market is a massive red flag. But the headline number feels deceptive when you look at the product life cycle.
It is highly deceptive. That Q2 sales decline isn't a symptom of market share loss or some failing value proposition.
It's purely a function of a brutal year-over-year comparison.
Exactly. It's a tough comp.
Yeah.
In the second quarter of 2025, Aflac launched their new cancer insurance product in Japan called Merito.
And when a dominant player like Aflac launches a highly anticipated, revamped version of their core product, you inevitably see this massive, immediate spike in sales.
Right, because there are huge agency forces out there aggressively pushing the new offering.
So Q2 2026 was being compared directly to that launch quarter anomaly.
Yeah, it's the classic tough comp. They were cruising at a much higher altitude last year because of the Merito launch.
And this year, they just returned to a standard cruising altitude.
Exactly. And management was very quick to point out that the first 6 months combined still shows 7% growth in Japan.
So the momentum hasn't broken.
Not at all.
But what I find far more fascinating is how they are maintaining that broader momentum, specifically the pivot they're making in their product mix.
You're talking about Sumitas.
Yes. During the call, management spent a lot of time highlighting Sumitas, which is a first sector savings type life insurance product aimed at younger demographics.
And this is a major strategic evolution for them. To really understand the gravity of it, you have to look at the quirk of the Japanese regulatory system.
Yeah, walk us through that, the sectors.
So first sector insurance refers to traditional life insurance and savings products, things tied to mortality or long-term asset accumulation.
Okay. And third sector?
Third sector insurance encompasses health, cancer, and medical insurance.
So products that pay out upon morbidity or sickness.
Exactly. And historically, Aflac is the undisputed king of the third sector in Japan. They basically invented the modern cancer insurance market over there.
Right. And I have to say, I'm actually pretty skeptical of this pivot to first sector savings products.
Really? Why is that?
Because Aflac's moat has always been their third sector cancer policies. Those payouts are fixed, they're mathematically predictable over large populations, and they're heavily insulated from macroeconomic shocks.
That is true.
I mean, if someone gets cancer, the policy pays out regardless of what the Bank of Japan is doing with interest rates. But with first sector savings products, you are taking on mortality risk, spread risk, and longevity risk.
You are.
So in a market famous for the oldest population on Earth and a historically volatile yield curve, why mess with the golden goose just to chase a younger demographic?
It's a completely valid skepticism. And honestly, the analyst community hammered on this exact point during the Q&A.
I bet they did.
Yeah, but CFO Max Brodin addressed it head on. The motivation really comes down to demographics and the current interest rate environment.
Okay, break that down for me.
Well, Japan has a rapidly aging population, meaning the pool of potential new customers for traditional cancer insurance is organically shrinking.
Right, there are fewer young people to buy it.
Exactly. To grow, Aflac has to capture customers much earlier in their life cycle. And Sumitas is an asset accumulation product denominated in yen.
So it appeals to younger people trying to save.
Yeah, young and middle-aged Japanese consumers who have suffered through decades of zero or even negative interest rates are suddenly looking for viable yen-denominated savings vehicles as the macroeconomic environment finally shifts.
So it's essentially a customer acquisition strategy, like a loss leader to get them in the door.
Well, not a loss leader, because they are generating very strong risk-adjusted returns on it right now, but definitely a hook.
Got it.
The strategy is to use the first sector savings product to initiate the relationship. A young professional comes in to talk about asset accumulation, and while the agent is securing that policy, they cross-sell the traditional third sector medical and cancer insurance.
So Aflac's leadership originally targeted a 25% concurrent sales rate, right?
Yes, meaning they wanted 1 in 4 Sumitas buyers to also buy a health policy.
And they reported that they are currently vastly exceeding that target.
Vastly exceeding it.
So it really is a Trojan horse. But regarding the risk you mentioned earlier, the spread risk and the mortality risk, how do they cap that exposure so it doesn't eventually drag down the highly profitable third sector business?
Brodin clarified that their current first sector in-source block is strictly capped. Right now, it sits at less than 20% of their total business.
Oh, okay. That's pretty tightly controlled.
Yeah, they are utilizing the current interest rate environment to secure good returns on these products, but they view it strictly as a diversification play, not a fundamental shift in their core identity.
So as long as it remains a minority slice of the portfolio, the cross-selling benefits far outweigh the incremental spread risk.
Exactly.
That makes the Japanese strategy incredibly clear. They are defending their core margins while using strategic new products to build the top of the funnel.
Right.
So let's fly the twin-engine plane back across the Pacific and look at the U.S. business. Because we see a very similar, yet distinctly American, cross-selling dynamic playing out there.
Oh, definitely.
So U.S. sales were up 2.6% overall, but U.S. dental and vision sales spiked an incredible 47% in the quarter.
47% is massive growth.
It is. Now, I want to present a theory here. When Virgil Miller, the president of Aflac U.S., highlighted that 47% spike, he noted that for every single dollar of dental and vision sold, they attached $1.07 of voluntary benefits.
$1.07 attach rate.
Right. My immediate thought was that this is a B2B Trojan horse strategy. This isn't a consumer standing at a counter deciding to add fries to their order.
No, not at all.
This is Aflac going to corporate HR managers and utilizing dental as the wedge.
Your theory is spot on, and it gets to the very heart of how workplace benefits are actually distributed in the U.S.
Yeah. Walk me through the mechanics of that.
Well, Aflac doesn't typically sell directly to the employee first. They sell to the benefits broker and the HR department.
Right.
And dental and vision insurance are considered core benefits. Employees demand them, and HR departments view them as basically mandatory for retention.
But things like critical illness, hospital indemnity, accident insurance Aflac's high-margin voluntary benefits, those are often viewed as optional add-ons.
Exactly. So if you walk into an HR director's office and just pitch accident insurance, you might get completely sidelined.
Because they have bigger fish to fry.
Right. But if you walk in with a highly competitive integrated network dental product, you win the contract for the whole company.
Oh, I see. And once you are the primary vendor for dental, you get preferential placement in the company's enrollment portals.
Bingo. You get right in front of the employee during open enrollment. And that is where the magic happens.
That is brilliant. It is a masterclass in unit economics and B2B2C distribution.
It really is. They use the lower margin, high demand dental product to secure the workplace real estate.
Then they leverage that real estate to attach $1.07 of high margin voluntary benefits for every dollar of dental premium.
Achieving a better than 1-to-1 attachment rate means the strategy is working flawlessly. They are acquiring high-value customers at a fraction of the traditional customer acquisition cost because the dental network acts as the acquisition engine.
I love the mechanics of that. I really do. But I have to push back hard on the U.S. margin profile here.
Okay, let's hear it.
Because if this B2B bundling strategy is so effective and they are attaching so much high-margin voluntary product, why did the U.S. benefit ratio climb 220 basis points to 49.5%?
That's the key question.
Right, because a higher benefit ratio means they are paying out a larger percentage of their premiums and claims. You can't just wave that away as a quarterly blip.
No, you can't.
If they are selling higher volumes through these B2B channels, aren't they inherently taking on lower quality risk pools just to get the volume?
It is the most critical question to ask when you see top-line growth coupled with margin compression. You absolutely have to monitor if they are underpricing risk to win market share.
So are they?
Well, the data provided by the CFO points to a different driver for the 220 basis point increase. The compression wasn't driven by the newly attached voluntary benefits at all.
Okay, what drove it then?
It was driven by an increase in incurred group disability claims. And they noted this was relative to highly favorable, unusually low results in the prior year quarter.
So we are looking at standard variance in a short tail line of business.
Precisely. Group disability is heavily influenced by macroeconomic factors, employment levels, and even just seasonal health trends.
Right, and those claims are reported and paid relatively quickly compared to, say, a 30-year life insurance policy.
Exactly. So a bump of 220 basis points is absolutely notable. I mean, it's the primary reason the pre-tax margin in the U.S. dropped to 20.9%. But it doesn't indicate a systemic failure in their pricing models.
Or a degradation in the quality of the new risk pools they're acquiring through dental.
Right. It is just the reality of the claim cycle normalizing. You expect margins to compress slightly when you face tough comps on the claims side.
Just as they face tough comps on the sales side in Japan with the Merito launch.
Exactly the same concept, just on the expense side.
That context is vital. It's not a broken engine, just, hitting expected turbulence.
Well said.
Now, before we look at the forward guidance, we absolutely have to dissect the global investments team's performance this quarter.
Oh, this is the best part.
It is, because insurance companies are, at their core, just giant investment funds that utilize insurance policies to source cheap capital or float.
Right. The investment portfolio is where the real leverage exists.
And Brad Dislin, the global chief investment officer, and his team executed what I consider the most sophisticated and impactful financial maneuver of the entire quarter.
Agreed. They repositioned $4.8 billion of their portfolio through a series of switch trades to capture higher yields.
Let's break down the actual mechanics of this, because I want to make sure every listener understands how brilliant this move is.
Sure.
So over the last few years, we have seen a historic rapid rise in interest rates.
Right.
If you are an insurance company, you are sitting on billions of dollars of older bonds that you purchased years ago when rates were effectively zero.
Right. Those old bonds might be yielding 2% or maybe 3%.
And in today's market, nobody wants a 2% bond when they can easily buy a brand new one yielding 5%.
Exactly. Consequently, the market value of those old bonds sitting on Aflac's balance sheet has absolutely plummeted.
So under normal circumstances, if an insurer wants to get rid of those old low-yielding bonds to buy the new high-yielding ones, they have to sell them at a massive discount, right?
Yes. And that realizes a significant capital loss on their accounting books.
Which severely damages their statutory capital levels.
Right. And that restricts their ability to pay dividends or buy back stock. It basically creates a trap where insurers are forced to hold on to underperforming assets simply to avoid the massive accounting hit.
But Aflac isn't a normal insurer.
No, they are not.
They have a massive structural advantage born out of their unique geographical footprint. The interplay between the US dollar and the Japanese yen.
This is where it gets so interesting.
Because Aflac holds a vast amount of US dollar-denominated assets, right?
Yes. And over the past couple of years, the Japanese yen has weakened drastically against the US dollar.
So because Aflac reports and manages a huge portion of its business from the Japanese perspective, those dollar-denominated assets have generated massive, unrealized foreign currency gains.
And that is the crucial loophole they exploited.
Okay, so how did Dislin's team actually execute it?
They executed targeted switch trades. They strategically sold certain assets specifically to harvest those massive foreign currency gains.
Okay.
And simultaneously, they sold $4.8 billion of the old low-yielding bonds realizing the capital losses on those.
I see. So the genius of the move is that they use the harvested currency gains to entirely offset the bond losses.
Exactly. On a net basis, the impact to their capital levels was zero. It was a complete accounting wash.
It is essentially laundering foreign exchange gains to organically upgrade the fixed income portfolio.
That's a great way to put it.
It's a wash on the balance sheet, but it is a monumental win for the income statement because they took the proceeds from selling the $4.8 billion in old bonds and immediately reinvested that cash into the new, higher-yielding assets available in today's market.
Right. So they permanently elevated their investment income moving forward.
How much of a boost are we talking about?
They expect the single quarters maneuver to boost their net investment income by a $50 million run rate on an annualized basis.
$50 million a year just from swapping paper.
Yes. And Dislin explicitly stated that they didn't just pack up and go home on June 30th.
They're going to do more.
They continue to see massive opportunities in the current rate environment and are actively planning to execute more of these switch trades in the third quarter.
Wow.
It requires an incredibly complex balancing act, though, managing taxable income, statutory liquidity, strict asset liability matching duration. But when they execute it this cleanly, it generates pure recurring shareholder value.
This perfectly illustrates why viewing Aflac purely as a dividend stock misses the whole point. It is a defensive fortress that actively weaponizes a higher rate environment.
They aren't victims of the yield curve. They are actively exploiting it.
I love that. All right, let's pivot from the investment portfolio to what management is signaling for the actual insurance operations for the rest of 2026. Forward guidance.
Yeah, the guidance provided a mix of caution and structural optimism.
Okay, let's start with Japan.
In Japan, they expect the benefit ratio to hit the absolute high end of their 60% to 63% guidance range for the full year.
Okay, so pushing 63%. And in the U.S.?
In the U.S., they are forecasting net earned premium growth for 2026 to come in just below their stated 3% to 6% target range.
But despite the Q2 dip we discussed earlier, they still expect total Japan sales to exceed 2025 totals for the full year.
Right. Yes, they do. And most importantly, they executed a major structural shift in their capital management, moving their internal reinsurance limit for the Japan business from 10% of U.S. GAAP assets to 30% of FSA reserves.
Oh, that is a huge move. But let's take these one by one, starting with the Japanese benefit ratio pushing toward that 63% ceiling.
Okay.
We established that a higher benefit ratio inherently means tighter margins because more capital is going out the door to cover claims.
Right.
But the mechanics behind why they are guiding to the high end requires us to talk about policy lapses and the accounting of reserves, right?
It does. The concept of reserve releases is fundamental to understanding insurance earnings volatility.
Explain that for the listeners.
Sure. When Aflac writes a policy, regulators require them to set aside a specific amount of capital, a reserve, to ensure they can actually pay future claims.
Makes sense.
So, if a customer holds a cancer policy for 25 years, Aflac has been steadily building and compounding a massive reserve against that specific policy.
Okay, and if that customer suddenly stops paying their premiums and the policy lapses...
If it lapses, Aflac is legally absolved of the liability to ever pay out a claim on it.
Because the contract is broken.
Exactly. Therefore, that massive 25-year-old reserve is suddenly released directly back into the company's current quarter earnings.
Okay, I always explain reserve releases using a piggy bank analogy.
Let's hear it.
Think of an older insurance policy reserve like a massive ceramic piggy bank. When an old policy lapses, it's like smashing open a piggy bank that has been stuffed with cash every single month for 2 decades.
Right.
A massive amount of money spills out all at once, and it artificially pads the bottom line, pushing the benefit ratio down and making profits look spectacular for that specific quarter.
That's a perfect way to visualize it.
But when a brand new policy lapses, say one of those Merito cancer policies they just sold 12 months ago, it's like smashing open a piggy bank that only has a few pennies in it.
Yeah, it doesn't move the needle on the bottom line at all.
Exactly. So that analogy perfectly captures the current dynamic in Japan.
It does. The CFO detailed that they are experiencing significantly fewer lapses of those older cash-rich policies.
So the older Japanese demographic is just holding tightly to their established coverage.
Exactly.
Right.
Conversely, they are seeing elevated lapse activity on the newer, recently launched products, specifically the Merito line.
Why is that?
This is a standard actuarial expectation when you introduce a highly competitive new product. Some consumers buy it in the excitement of the launch, realize a few months later it doesn't fit their budget, and just let it lapse early.
Right. And because those are immature policies, there's virtually zero reserve release to cushion the benefit ratio. So the piggy banks they are breaking open right now are essentially empty.
Yeah.
So the sheer mix of who is lapsing means the benefit ratio isn't receiving its usual artificial boost, naturally floating it toward the higher end of the 63% range.
Exactly. And management expects this dynamic to normalize over time. As the Merito product block ages past its first and second years, the lapse activity naturally stabilizes.
So those policyholders who stay become long-term persistency customers.
Right, and the benefit ratio should drift back toward a more comfortable median. It is a temporary accounting headwind, not a fundamental deterioration of their underwriting quality.
Okay, that makes total sense. Now, we cannot discuss forward guidance without addressing the massive elephant in the room that every retail investor hyperfixates on when analyzing Aflac.
Yen volatility.
Yen volatility. We've watched the yen swinging wildly in the currency markets, hovering anywhere from 158 to 164 to the dollar, dominating financial news cycles.
All anyone talks about.
Yeah. So if Aflac generates the lion's share of its operational cash flow in yen, shouldn't investors be fundamentally terrified of these daily violent currency swings?
It is the single most misunderstood aspect of Aflac's enterprise risk profile by the broader retail market.
So what's the answer?
The definitive answer is no. You shouldn't panic over daily Forex charts.
Okay, but why?
Understanding why requires a deep dive into asset liability management, or ALM. Aflac does not simply take yen profits and convert them to dollars at the daily spot rate.
Right, they aren't day traders.
They run an incredibly sophisticated long-term enterprise hedging program, specifically designed to immunize the economic value of Aflac Japan against these exact fluctuations.
I want to make sure we make the mechanics of ALM crystal clear for the listeners.
Sure.
Essentially, Aflac's primary objective is to protect the underlying economic value of the Japanese business when translated into U.S. dollars.
Right.
And they achieve this by strictly matching their liabilities. The future claims they are legally obligated to pay out in yen with assets and debt that are also denominated in yen.
Exactly. They currently hold approximately 63% of their corporate debt in yen.
Which is key, because when the yen weakens violently against the dollar, the translated dollar value of the Japanese earnings obviously decreases, which creates the headline headwind we saw in the EPS growth.
Yes, but simultaneously, the translated dollar cost of their massive yen-denominated debt load also plummets.
It's a massive, naturally occurring hedge built directly into the balance sheet structure.
It is. Furthermore, their explicit foreign exchange hedges, the derivatives they purchase to smooth out the remaining exposure, are designed with a 30 to 40-year time horizon.
Wait, 30 to 40 years?
Yes, to match the duration of their insurance liabilities. So a 4% intra-week move in the currency market might create panic on financial television, but to an actuarial team hedging liabilities that won't come due until 2060.
It's just statistical noise.
Exactly. The CFO explicitly stated on the call that a 4% move on the day is, and I quote, actually quite minor in the scheme of things regarding their hedging program.
They are managing decades-long economic value, not quarterly translation risk.
Exactly right.
That is the fundamental reassurance investors need. You don't day trade Aflac based on Forex technicals. You hold it because the underlying machinery is generating compounding cash flow regardless of the daily exchange rate.
Perfectly said.
Which brings us to the ultimate bottom line. We've dissected the operational margins, the inflationary pressures, the brilliant B2B Trojan horse in the U.S., the bond portfolio switch trades, and the ALM hedging mechanics.
We've covered a lot of ground.
We have. So what is the definitive actionable takeaway for someone holding this stock or evaluating it for their portfolio?
The definitive takeaway is found entirely in their capital return metrics. In the second quarter alone, Aflac returned $1.3 billion directly to shareholders.
$1.3 billion in a single quarter.
Yes. That breaks down to $983 million in aggressive share repurchases and $309 million in dividends.
And if you look at the first 6 months of the year cumulatively, they have returned $2.6 billion.
It's staggering.
And we cannot gloss over the historic nature of that dividend. Aflac boasts 43 consecutive years of dividend increases.
43 years.
They maintained and grew that payout through the dot-com bust, the great financial crisis, a global pandemic, and decades of stagnant, zero interest rate policy in their primary Japanese market.
Right. Through every conceivable macroeconomic environment, they have raised the payout.
So what's your stance?
It is the defining characteristic of the equity. For value investors, dividend growth investors, or anyone looking for stability, the stance on this quarter has to be definitively bullish.
Bullish, I agree.
Because Aflac operates as an absolute cash cannon. Even in a quarter where you have significant currency translation headwinds and essentially flat EPS growth, they effortlessly handed $1.3 billion back to the owners of the business without straining their capital ratios.
So let's make this highly actionable for the listeners. If you are sitting there holding Aflac in your brokerage account right now, my firm advice is to turn on the DRP, the dividend reinvestment plan, and just let it run on autopilot.
Let management do the work.
Exactly. Management is buying back nearly $1 billion of stock every 90 days. They are systematically shrinking the outstanding share count for you.
Your percentage ownership of this financial fortress is growing larger every single quarter without you lifting a finger.
And those reinvested dividends are compounding on top of a shrinking base.
Now, for those considering initiating a position, you should really frame Aflac as a core defensive pillar in your portfolio construction.
Give me an example.
Sure, if you are highly exposed to high multiple technology stocks and are worried about valuation compression, or if you are anticipating a domestic U.S. consumer recession, Aflac provides the ultimate counterbalance.
Right, because we just detailed how they actively profit from a higher interest rate environment, swapping bonds to generate an extra $50 million a year in pure income.
Moreover, they are heavily insulated from domestic U.S. economic shocks because their primary revenue engine is derived from Japanese health insurance, which is incredibly sticky.
Consumers do not cancel their cancer insurance coverage just because the global economy slows down.
They absolutely do not.
It is the ultimate sleep well at night stock. But, just when you think the story is purely about steady, predictable cash flow, I want to leave you with a massive under-the-radar catalyst to mull over.
Ah, yes. We always like to highlight something buried deep in the Q&A that the headline algorithms missed.
We do. And this quarter, the most explosive potential catalyst revolves around the technical shift in their reinsurance strategy that we briefly touched on earlier.
The Bermuda move.
Yes. An analyst specifically asked about Aflac moving its internal reinsurance limit for the Japan business to 30% of FSA reserves.
So for context, Aflac utilizes a captive reinsurer domiciled in Bermuda to reinsure parts of their Japanese business.
Right. And the analyst dropped an absolute bomb of a question, estimating that shifting to this 30% limit could eventually free up $5 billion to $7 billion in excess capital.
And to understand why that number is so massive, you have to understand the regulatory arbitrage at play.
Right. Tell us about the FSA.
The Financial Services Agency of Japan, the FSA, requires incredibly conservative, rigid capital reserving requirements.
We want a lot of money locked up just in case.
Exactly. Now, U.S. GAAP accounting is slightly different, but Bermuda operates under a regulatory framework that often provides equivalency while allowing for far more efficient capital models.
Okay.
By transferring those liabilities to their Bermuda captive, they can legally hold significantly less capital against the exact same risk profile.
Oh, wow. So the spread between the conservative FSA requirement and the efficient Bermuda requirement represents that $5 to $7 billion of trapped capital that is suddenly being unlocked.
That's exactly it. And the CFO didn't even dispute the math.
Right. He noted the exact figure depends on the evolving mix of medical versus cancer business being reinsured, but he pointed directly back to an older presentation that essentially validated the analyst's massive ballpark estimate.
$5 to $7 billion of newly freed up capital.
So the critical question you have to ask yourself as an investor analyzing this company over the next 24 months is, what does Aflac do with a $7 billion war chest?
It's a great question. CEO Dan Amos was pressed on potential M&A activity, and he played his cards very close to the vest, stating they remain careful and that properties are usually up for sale for a reason.
But come on, you don't orchestrate a complex international regulatory unlock of $7 billion just to let it sit in a checking account earning the risk-free rate.
You absolutely do not. That magnitude of capital unlock provides immense transformative optionality.
Like what?
It could indicate they are preparing for massive, one-time special dividends in the near future.
Or it could fund a historic, accelerated share buyback program that would dramatically compress the share count and artificially explode their EPS growth.
Or, despite Amos playing it cool, they could be quietly stalking a major synergistic U.S. acquisition to dramatically scale up the domestic side of the twin-engine plane.
Utilizing that captive capital to fund the purchase without taking on expensive public debt.
Exactly.
Whatever mechanism they ultimately choose, it serves as a massive structural tailwind for a company that is already functioning as a perfectly calibrated cash cannon.
It really does.
You look at the chart, and you see a boring legacy dividend pair. But you look at the underlying mechanics, the actuarial discipline, and the strategic capital management, and you see a financial fortress preparing to unlock billions of dollars in shareholder value.
Keep a very close eye on how they deploy that Bermuda capital over the next few quarters.
Absolutely. Well, thank you for joining us on this extensive deep dive into the underlying mechanics of Aflac's quarter.
We bypassed the standard lightning round today because when the financial engineering is this sophisticated and the capital flows are this massive, understanding the nuance is the only way to find the alpha.
Stay curious, keep scrutinizing the data behind those tickers, and we'll catch you on the next deep dive.